Is 2024 going to be the year in which SoFi finally rallies and gives us investors the returns that we were hoping for? Let me walk you through the 3 or 4 key events that are going to happen that, in my view, are going to be, well, let me give it away, fairly bullish. And of course, it's not financial advice, just an old banker sharing his thoughts, but let's get cracking. And here we are. Oh, yes. Do you want to learn how to make your money work for you in 2024 and stop slaving away for money? That's what the 99% do, whereas the 1% actually make their money work for them. And it's way simpler than you think, and I'll teach it to you for free. Just go over to felixfrenzel.com/webinar. We do a live trading training. I teach you our 1 stock, 3 rule, 75% win ratio system. It's very, very, very simple, and I give it to you. So come and join me. Now, the big, juicy news about to happen as I'm recording this is SoFi will be profitable from the 4th quarter of 2023 onwards. That's the first quarter where they're really like gap profitable, real profitability that would please Charlie Munger, rest his soul. And what I would expect is that in all quarters in 2024, we would expect to be profitable. Does that then bring S&P 500 inclusions on the horizon? Well, let's come back to that thought in a moment, but hold on to that thought. It's an important one, and we'll walk through what the timeline might look like there. First of all, I want to run you through a little bit of what's expected and what SoFi needs to do to beat the expectations, and that's what a stock needs to do. It needs to beat expectations to go up. Meeting expectations isn't really the thing here. If you look at student loan originations, they were glorious in the good old days before Papa Biden decided to sort of suspend moratorium student loans for whatever reasons. And by the way, I think student loan debt is a scandal, but I don't think forgiveness is the solution. I think you need to go to the source that's causing the problem, which are colleges charging far too much, and you've got far too much wealth and delivering far too little. But that's just my view on it. So we've been in this period here where there is almost zero student loan origination. That's going to come back. And they already guided that it's going to come back, but they're guiding on a very, very, very low end. So even if that only comes back into sort of the 2022 levels or so, it will in itself cause a massive beat against analysts' expectations. So there's some really easy growth here for SoFi to be picked up from the student loan business. Now, this is something else investors are going to love. And I want to give a huge shout out here to this Twitter account, Data Driven Investing. He does an amazing job. Give him a follow. And he walks through this very, very nicely. I thought I'd explain it to you. SoFi is, from a dumbass analyst point of view, going to pay $4 billion of debt off. And you're thinking, have they got debt? Well, no, not really. But the way the market looks at this is a little bit odd. So at the moment, SoFi has about $4 billion in sort of lending facilities, and that's credit that they were getting from other banks, and they're using that money to essentially fund loans that they're handing out. And they are going to be paying that off, in a sense. So by hitting their capital ratios, the loan book will not grow as fast, but the deposits will keep growing. And the deposits will then offset the need for these credit facilities. And therefore, their loans, SoFi's loans that they're handing out to people, will be fully funded by own capital and by own deposits. And the way the market looks at this is that SoFi is paying off $4 billion in debt. And a lot of people look at stocks for like 30 seconds. They look at, is it profitable? How much debt have they got? That's the first thing that they look at. Then they might look at margins. So if it's not profitable, they might disregard it. SoFi will be profitable. And if they've got a lot of debt, they might also go, that looks dodgy, weird. I don't care. Let's move on to Coca-Cola, the stock, not the beverage, unless it's Charlie Munger's sidekick. So this is a good thing. And therefore, it's going to improve valuations. And you can look at this in various ways, but a lot of people look at enterprise value, which is essentially market cap plus debt, and then minus cash. So the 4 billion in debt that disappears is going to improve multiples. So say here, and he runs through an example, SoFi's market cap is about 9 billion right now, as I'm recording this. Their debt is 6 billion, cash is 2.8, so the enterprise value is about 12.5 billion. And let's assume here that they're just going to pay off the 4 billion, nothing else changes. It means the multiple almost halves. So this EV/EBITDA multiple, which a lot of people look at, essentially looks almost twice as shiny as it does right now. And I know this is kind of technical and a little bit accountancy, but it is actually important, and that's one of the reasons SoFi also wanted to become a bank, so they could take in deposits and they could look much better than previously. Now, analysts, the Wall Street Muppets out there, are expecting in the last quarter of 2023, 30% growth. And after that, for some reason, they think SoFi is basically not going to grow anymore. Somewhere between 1 and 6% is the growth, which is just weird, because look at revenue growth over time. It was at one point 80% pre-student loan kneecapping, and then it sort of slid into the 20 to 30% excluding any student loan growth. So we would expect that to hover at least around the 20 to 30%, maybe even go a little higher with the student loans. So again, very, very easy. It should be very, very easy to beat these estimates. So this here is forecasts, whereas this is what actually has been happening. So it'd be kind of hard to see why would growth drop this much. I don't really see it. I think there's a lot of easy growth out there still for them. I think growth numbers are massively underestimated. And bear in mind that Noto is an under-promiser and an over-deliverer, and that's a smart thing to do if you're on Wall Street. See all the green numbers on my screen here? Every single time there's a green number, they've beaten revenue guidance. And every single time there is an EPS, a profit green number, it means they have beaten profit guidance too. And there were 2 quarters where they didn't. Well, that's just after the student loan moratorium came into force. At the same time, and let's then talk back about the S&P 500 inclusion, there is not a CEO out there that I know who's as well incentivized as Anthony Noto. So he has stock options, but the way they work is he gets a third of his stock options. Look at this. He gets a third of his shares at a $25 share price. The next third at $35 a share price, and the last third at $45. So, and this is by summer 2026. So he has a massive $100 million worth of incentives to 4x the stock price in the next 30 months. That doesn't mean he's going to pull it off, but he's certainly got the incentive to do it. So what he's actually getting paid isn't all that much. And bear in mind, he's been buying SoFi stock at these prices as well. So really, this guy is really tying his compensation to stock price performance like no one else I've ever seen out there. So 4x is what he's gunning for by summer 2026. Let's see what he does. Now let's walk through S&P inclusion. How does this really work? Well, to be included in the S&P, you need to be an American business. You need to have 4 quarters of real profits. You need to have a market cap of around 15 billion plus, and that would equate to a share price of around $15 plus. They will hit the 4 quarters of profitability in Q4 2024. That doesn't mean you get included straight away. Typically, the S&P will sit on it for about 3, 4, 5 months. Tesla took 5 months, for example. I think we're going to see the similar thing with Palantir. So there is a chance that, say, by March or April 2025, and that seems like a long time ago, they might get an S&P 500 inclusion, all being well. What happens in S&P inclusion? Well, have a look at Uber here, for example. Uber pops on inclusion on the S&P, writes, I think it was Reuters, where I screenshotted that, and have a look at the share price here. So announcement essentially came in here through their earnings being profitable, and then they went from $47 up to $61 in the space of 2 months or something like that. So you get these, what is that, $14, that's, what is that, 25, 28% or something. That's pretty whopping, and that'll probably go up some more when the actual inclusion is sort of done, and all the, actually, I think, has it already happened? I think it might have already happened. I think that here might have been it, the volume there. So what happens is that all the index funds, all the tracker funds, all the ETFs, they all buy it. There are also a lot of pension funds out there who either track the S&P 500 index or simply are only allowed to buy stocks that are part of the S&P 500 index because they are only allowed to buy profitable businesses, for example. So a lot of good stuff here in the pipeline, I'd say. Now, I was thinking, like, could I put out a trade idea for this? As this is a 2024 video, without wanting that trade idea to date within 3 days. You could do something like this. And I'm not usually a huge fan of these very, very long dated trades, but I thought I'd throw it out here. So this is a trade that expires in January 2025. It's a bull put spread, which means we are bullish. And the way we've set this up here is that our break-even line is down here. This dotted line here is our break-even. That literally sits at $6.36. And it just means the stock could drop like, 30%? And we'd still be okay at expiry. And it could, in theory, give you a 45% profit, which is not terrible. It's a fairly cautious, conservative setup, though you do want to be aware of how options work before you do that kind of thing. But yeah, that's the sort of thing, if I really had to do something long term, I would. In reality, I would probably prefer to do shorter term trades that are each about 40 days long and just do, 6 or 8 or something like that or over the year, rather than do a really long one. But I just wanted to show you what you can actually do, which is cool, that you can push your break even so low that if the stock goes up, you make money. Or if the stock goes down all the way to like 636, you're still making money. So that is what makes this, lower risk potentially. And you want to learn a little bit more about how that works? Come and join me on a live trading session. We'll walk you through, give you the rule book, which is really, really very simple, and it'll really put you on the path to making your money work for you. And that's what you want. You want your money to work for you. Stop working for money. That's really what splits society between the 1% up there and the 99% down here. So come and join me, felixfranceorg/webinar. Let me know what you make of SoFi for the year. Love to hear your thoughts. Anything I missed, put it down below in the comments. And I thank you for watching. And it'll be an exciting year. I think that's guaranteed.